Hey everybody, welcome back to the show. So today we have another edition of 5 Question Friday. That's where I take a look at 5 of the questions that you all asked during the live show that I do every other Monday at 7 p.m. Eastern Time. Questions that I didn't get to during the live show, and well, I cover them every Friday. I cover 5 of them, and I got 5 good questions this week. Well, actually, you do. You guys have great questions, and this week is no exception. So let's dive right in. The first one has to do with the valuation of the stock market right now, which I think most would say it seems pretty richly valued. And should we use that to determine how we're going to invest? Here was the specific question. They said, what are your thoughts on holding off on maxing out our investments right now to build up a bigger cash reserve so that we can invest at some point in the future based on the Shiller PE? It's a great question. I get this kind of question in a lot of different forms. So let's start with the Shiller PE. Let me show it to you. Here it is. This is just a cyclically adjusted PE. What they do is they take normally P is for price of a stock or an index fund. E are the earnings. And so normally when you calculate the PE, you use either the earnings of the last 12 months, called trailing 12 months or TTM, or you use some estimate of a company or an index's future earnings over the next 12 months. That's normally what you do when you see a PE. That's how it's calculated. But what this does is Shiller PE, sometimes referred to as CAPE, C-A-P-E, cyclically adjusted price earnings ratio. It takes a look at earnings over a 10-year period, so over the last decade, makes adjustments for inflation and calculates the PE. And so our current PE on this basis is 37.35. And we can tell just from the chart, this goes all the way back to the 1800s, believe it or not. But, if we just look at more recent times, we're not at an all-time high, but we're awfully close, right? This was the tech bubble into 2000. This was following COVID. So we're towards the end of 21. And now, today, we're at 37.35. And so the theory is, well, hey, we don't know exactly when this is going to drop. But I mean, if we just look at history and the idea of reversion to the mean, and boy, stocks are highly valued, it's going to drop at some point. And so why don't we just wait, build up cash, and then when it drops, we can invest. Now, in theory, I don't think that's necessarily a bad idea. Certainly, I can understand the logic behind it, but in practice, it turns out to be, I think, very, very difficult to do for a couple of reasons. The first is valuation, I do think, is a good indicator of the returns that we can expect, say, over the next decade or so. And if we look back at history and go back here, a lot of study has been put into how the Shiller PE can predict not only future stock market returns, but even things like the safe withdrawal rate in retirement. And for longer term, think a decade at a time, it's got a fairly decent track record of predicting returns, not like down to the penny or the percentage, but the idea being that the higher the PE, the lower the returns will be, say, over the next decade. All right. However, it's not particularly useful for predicting returns over the next 12 months. And you can see why. For example, it's easy to look at this 37 number now, but let's go back. Here it was 23. That's still well above the average. We can look the average, the mean is 17. So we could have been sitting here at 23 thinking, oh boy, we should just wait. And what it's done more or less for the last 14 years is just go up. Obviously, COVID was a big deal, and then 22 was a bad year. It's easy to look back on these different periods of time. Oh, yes, of course, COVID. And yes, of course, 2022, eventually we were going to have a bad year. But living through it and being able to time the market based on valuations is very, very difficult. And it's just not a good indicator of what the next 12 months will be. And in fact, there was an article that I included in last week's newsletter that I thought was a really good article on this very point. And one of the things they noted, this is the attempt to correlate a price earnings with returns over 12 months. And you can see basically what this means is, it ain't very good at it. And in fact, the correlation The way they tested it, I don't believe they used the Shiller PE in this case, but I don't know if you can read that, it was a negative 0.11, which basically meant there's not much correlation at all between valuations and short-term market returns. And so in theory, I understand the concept that, boy, we're at high valuations now. Eventually, this is going to come down. But the problem is, one, you could wait a very long time for that to happen. And two, you're still going to have to decide when to go back in. I mean, are you going to wait until it gets all the way down to the average? Are you going to wait till this gets down to 30, 25, 20? And then what's going to happen? It's going to go back up, and then it's going to go down, and then it's going to go back up, and then it's going to go down. In other words, it's going to fluctuate, which is what stock prices do. And I think personally, it can be very, very difficult to actually use valuations like this to invest in a broad-based, say, portfolio of index funds. If you're investing in an individual company, I think valuations are one of the key drivers to an investment decision. But even then, if you're picking a stock that you think is undervalued, you shouldn't be thinking to yourself, and therefore it will go up in the next 12 months. That very well may not be the case. So I think I understand the idea behind it, the sentiment. Yes, the market seems richly valued, but I don't think it's personally an effective way to invest consistently over the long haul. But great question. That's my take on it. All right. Question number 2, really important one about Roth conversions. Does it really matter if you pay taxes out of the proceeds of the IRA conversion itself, or from, say, cash you have in your checking account or some other taxable account? Why would you, and then also related, why would you have that cash sitting there in your checking account, let's say, doing nothing anyway? Great question, and it matters a lot. And let's just use a simple example. Let's imagine we're going to convert $10,000. We'll assume a 25% tax rate, maybe between state and federal. So we're going to have to pay $2,500 in taxes. If we pay it out of the conversion, then our $10,000, $2,500 goes to Uncle Sam, $7,500 goes into our Roth. So we have $7,500 in a Roth. And let's just assume for the moment that we had $2,500 in our checking account. It's still there, right? Because we didn't touch that. So that's one scenario. The other scenario is, no, we take the entire $10,000, put it into a Roth, and we take the $2,500 out of checking, and we pay Uncle Sam with that amount. So effectively, the difference between these two scenarios is what happens with that $2,500 in the checking account and how much do we get into our Roth. If we use the $2,500 in the checking account to pay Uncle Sam, we get the full $10,000 conversion into our Roth. In effect, what we've done is taken that $2,500 and moved it into the Roth. And that is a huge advantage because that's $2,500 that won't be subject to tax each year when it earns interest and dividends. It's also $2,500 that won't be subject to capital gains tax when at some point in the future we sell it, perhaps to live on in retirement or whatever the case may be. And that is a huge advantage of paying the tax from outside the IRA IRA money itself. Another way to think about it is this. If you pay the tax out of the conversion proceeds, then whether the Roth IRA conversion turns out to be a good deal for you depends entirely on the amount of tax you paid at the conversion as compared to the tax you would have paid at some point in the future had you not done the conversion. You left the money in the IRA and say you took it out in retirement or maybe because of RMDs or what have you. Which marginal tax rate, not tax bracket's important, but there are other things that can affect how much tax we pay, tax on Social Security, extra premiums for Medicare, those sorts of things. It's more than just the bracket. But whether it turns out to be a good deal is the tax you paid when you made the conversion or would have paid had you made the conversion, and the tax you pay when you take the money out or would have taken the money out, right? That's it. That decides whether it was a good deal or not. However, when you pay for the tax from, say, your checking account so that you can convert the full, in our case, $10,000, you get an extra benefit. That $2,500 that was in your checking account that effectively has been moved into your Roth, but you get tax benefits from having that in a Roth over in a checking account or a taxable brokerage account. And as a result, how long you keep that money in the Roth matters too. right? Because every year you keep that money in the Roth and don't spend it is just another year where that $2,500 can grow tax-free. If you pay the money out of the conversion, the tax out of the conversion, how long you keep the converted money in the Roth doesn't matter. It doesn't change the equation at all. But if you pay the tax out of, say, a taxable account, how long you keep it in that Roth does matter. And the longer you keep it in there, the more benefit you get from having paid the taxes out of a taxable account. And in fact, I'll show you this video that I would highly recommend. This is Mike Piper. This was a presentation he gave at the Boglehead Conference this year. You can just Google or go to YouTube and Boglehead Conference 2024 Roth Conversion Deep Dive with Mike Piper. One of the points he makes in this video that I found interesting is that that benefit of effectively taking $2,500 out of a taxable account and effectively moving it into the Roth, that's what happens. That can actually be the source of the most benefit of the Roth conversion. So it's really, really important if you can do it. Now, the other part of the question is, well, who has $2,500 or whatever your amount might be just sitting around in a taxable account ready to pay taxes on a Roth conversion? And yeah, I get that, but that's where planning comes in. If you've got a plan for Roth conversions over a number of years, to the extent that you can, set that money aside for payment of those taxes, it does add, I think, a big benefit to the Roth conversion. Now, again, if you can't do that, it doesn't mean a Roth conversion isn't worth doing. There, though, it's just a question of comparing the two tax payments that you would make either at the time of the conversion, if you did one, or some point in the future where you pulled the money out of the IRA. So there you go. Excellent question, and I highly recommend Mike Piper's presentation. It was very good. All right, question number 3. What are your thoughts on using dividend funds like SCHD, that's a Schwab fund that I own shares of, I'll show you that in a minute, and skipping bonds entirely? I'm almost retired, but will have a pension, so will not be totally dependent on my 401k. So a couple of things there. When you think about your asset allocation, stocks, bonds, and so forth in retirement, to me, one of the important questions to answer is, how much of my retirement savings will I spend each year? Now, with this question, they mentioned, hey, I've got a pension. Presumably, they've got Social Security. So they may not need much of their 401k or other retirement savings. Of course, what does that mean? Does that mean 1 or 2%? I think once you get to 4 or 5%, your asset allocation matters a lot. And I tend to go somewhere as close to 75% in equities as I feel comfortable in that scenario. But if you only need 1 or 2%, at least based on historical studies, you could probably get away with just about any asset allocation. Again, the future is not guaranteed, but at least if we look at history, including Bill Bingen's work on the 4% rule, you could have a wide range of asset allocations and your money would still last 30 years. But what about SCHD and other types of dividend-focused ETFs? Well, let me show you this fund. Here it is. So this is a stock fund. This is not, there are no bonds. We can go to the portfolio. And yeah, it's all stocks, almost all U.S. equity, but it does focus on dividend paying stocks. And so it's got a dividend yield of 3.31, the more recent yield 3.5. The way I put that in context, because one could look at that and say, well, is that good or bad? I suppose you could compare it to a bond fund. We could do that now. We could go to B&D and we could look at this. It's probably going to be a bit higher. You have 440. Now, this is going to be in the form of interest because it's a bond fund, right? The Schwab fund, this 350, is going to be in the form of a dividend. That matters if you're in a taxable account because taxes will be different. In a retirement account, the differences wouldn't matter from a tax perspective. But the other thing we could do is we could look at it and compare it to, let's say, the S&P 500, and I'll just use Vanguard's S&P 500. Its yield is 117. So that's really low compared to the Schwab yield. But that still raises the question, is this a good bond alternative? Here's how I think about that question. I think about it in terms of the volatility of the fund. If we go back to B&D, which is of course not the only bond fund we could look at, but this is an intermediate term sort of total bond market fund. It includes government bonds, corporate bonds. If we go to the portfolio, we're going to see that the duration is about 6 years, right? And if we go to risk, we can see the volatility. And I use standard deviation, and it's 7. So this number, think of it as the higher the number, the more volatile the price of this investment is. The swings up and down. All right. So again, 7.7 in a vacuum, that number by itself is probably not all that meaningful to us by itself, but we can go back to Schwab, the SCHD fund, and how does its standard deviation compare? Remember, the bond fund was, we'll call it around 7 or 8. This one's almost 16. So it's much, much more volatile. Now, it's not quite as volatile as this S&P 500, which I think is around 17. But when I look at this, I see a fund that it's a stock index, a stock fund, and it behaves like a stock. Now, it's a tad less volatile than S&P 500, but not much. But it's more than twice the volatility, or we'll call it twice the volatility of a intermediate term total bond fund. So for me, it's not a good alternative to a bond fund. And now, that doesn't mean that you need bonds in your portfolio. If you're only spending 1% of your retirement savings and otherwise comfortably living off of Social Security and pensions, you may decide that you don't need much, if any, exposure to fixed income. It might not be the decision I would make even in those circumstances, but one I think could make the argument for it. But it wouldn't be based on this idea that an investment like this Schwab dividend fund is a fixed income alternative. I just don't think it is. And for me, the key metric is that volatility, that standard deviation. That's at least how I look at it. But good question. All right. That was question 3. Question 4, why is the 3-bucket portfolio so popular? Isn't it much more complicated than a 60-40 portfolio that you rebalance annually? So yeah, a 3-bucket, the sort of standard 3-bucket portfolio has a bucket for cash, a bucket for fixed income, and a bucket for stocks. You can work it in a number of different ways, but that's one example of it. And here's the key. You're going to decide how much cash in bucket 1 based on years of expenses. So if you're going to pull, let's just say $10,000 a year from your portfolio and you wanted 2 years worth of cash, you'd have $20,000 in bucket 1. And you might say, and again, this can vary. This isn't, this could be customized to your whatever you'd like. But let's say someone says, "Oh, for fixed income, I want 7 years of fixed income." So that would be $70,000 in bucket 2. And then all of the rest of whatever you have would be in bucket 3 in stocks. That's sort of the idea. And then the question becomes, all right, but how do you rebalance this, or how do you decide which buckets to spend from? And here you have to come up with what can be, it doesn't have to be necessarily, but can get pretty complicated set of rules to decide, well, when am I going to spend from the stock bucket or the cash bucket? In normal years, let's say the market is up, what folks will often do is they've spent down a year's worth of cash, so they'll take money out of the fixed income bucket to fill up the cash bucket back up to $20,000. And that typically leaves their fixed income bucket a little light. So they sell some stocks in bucket 3 and move that to bucket 2 to get back up to, in our example, 7 years worth of fixed income. And that's what they do each year. But the idea behind it, and I think this is why it's so popular. Let's imagine stocks are down 20%. Well, the thought is I've got 2 years of cash and 7 years of fixed income to protect me and to protect my bucket number 3 of stocks. I won't touch it. I don't want to sell stocks when the market's down. That's okay. I've got this big cushion that makes me feel comfortable, helps me sleep at night. I can spend down my 2nd year of cash if need be, and then I've got 7 years of fixed income. Yes, that can fluctuate up and down a bit, but it's not nearly as volatile as stocks. And I'll just wait it out. And if it's 2 or 3 years of a bad market, that's fine. 4 years, 5 years. I've got 2 plus 7. I got 9 years I can wait out a really bad market. And then once the market rebounds, then I can sell stocks to refill up my cash and my fixed income bucket. That's sort of the theory behind it. The problem I have with it is that when stocks are down, it's not that you want to completely ignore bucket 3. You actually want to fill up bucket 3, right? When stocks are down, we want to rebalance, sell fixed income to buy stocks. And the bucket strategy doesn't really lend itself to that in an easy way. I suppose in theory someone could say, well, no, we'll just sell fixed income and buy stocks if the market's down. But it gets confusing because remember, we started off assuming 7 years of fixed income. So are we going to reduce that number when stocks are down in order to buy more stocks? And how low does that number get? And I kind of agree with the viewer's question. It just seems overly complicated to me. I think a much better approach is just a 60-40 or 70-30 or whatever asset allocation you have, and rebalance based on percentages. The real problem comes in when we have this fixed income bucket that's based on years of expenses. That's really what creates all of this problem. I think it's fine to have 1 or 2 years of cash if that's what you want. But when it comes to fixed income, instead of defining it in years of expenses, just give it a percent. Maybe it's 30%. And stocks are 70%, and then you've got your cash separate, and it's 2 years worth. That's fine. And you can always take that 30% of fixed income or 40% or whatever you've decided for you, and you can do the calculations to say, okay, that'll give me 9 years worth of spending. And write that down. Put it on a Post-it on your refrigerator if it makes you feel better. It's just that when we start to actually allocate between these buckets based on years of experience, years of expenses, that's where I think we start to run into problems and unnecessary complications. Just leave it as a percentage and then translate it into years of expenses if that makes you feel better. And I'll tell you, it makes me feel better. So occasionally I run through those numbers in my mind. I don't have a Post-it note on the refrigerator. My wife would probably wonder what in the world that was. Okay, fifth and final question. How do you think through how much you need to withdraw in retirement as a function of your pre-retirement salary only? So the short answer for me is I don't. That's not how I think about it. I don't think about retirement spending as a percentage of my income, and I'll explain why. But before I do, let me just show you this. This is from the Fidelity website, and you can just Google Fidelity, how much do I need to retire, and you'll find it. This idea of targeting your either how much you need to save or how much you'll spend in retirement based on your income is common. And this was a rule of thumb that Fidelity came up with. At 30, you should have 1 times your salary saved, all the way up to at age 67, you should have 10x your salary saved. And this rule of thumb is based in part on spending a certain percentage of your salary in retirement, along with, of course, Social Security and possibly a pension. And I think, using this sort of rule of thumb to sort of gauge your progress, particularly when you're decades away from retirement, I think is not unreasonable. But when it comes time to actually planning your retirement, and I would think this is going to be 5 to 10 years out. You could certainly do it earlier than that, but certainly when you're in the 5 to 10 years to retire range, you need to be thinking more about your actual budget and what you plan to spend in retirement, not based on a percentage of your income, but based on your actual spending. And that's where retirement planners come into play. We've talked about them a lot on this show, and there's a lot of good ones. There's Prelana, there's Bolden, there's Projection Lab. Those are 3 of them. I'll leave a link below this video to an article where I talk about many of these. I think those are all good options, but what they sort of force you to do is to think about your actual spending in retirement. For me, the starting point is what you're spending now. Now, you could make some adjustments for that, right? Let's imagine you're 10 years out from retirement. You have your monthly budget or your annual budget. You use a budgeting app, for example, and you've got it there. And you could make some adjustments to it. So maybe that includes your mortgage, but you're going to have paid off your mortgage by the time you retire. So in your retirement planning software, you make an adjustment for that. Maybe you're paying for your child's college tuition, and hopefully they're going to graduate in 4 or 5 or 6 years, and that'll be paid off. And so you can adjust that in your budget. So you can make some adjustments. In many cases, it reduces what you're going to spend, but who knows? Maybe you plan to travel the world, or you have a hobby that's going to cost some money. You can make those adjustments and actually come up with a spending plan. To me, that's what you should be basing your retirement plan on, not a percentage of your income. So there you go. 5 great questions. Really appreciate them. If you have any comments about them or questions, leave those below the video. And until next time, remember, the best thing money can buy is financial freedom.